Welcome back to another episode of Palisade Radio. I'm your host, Karem Mutlu, and on today's show we have David Hunter, who's a contrarian macro strategist with over 40 years of experience on Wall Street. Welcome to the show, David.
Thank you, Karem.
Let's begin by talking about gold and silver and how you see the metals performing over the first half of this year. In a recent letter you sent to clients, you suggested that the metals will begin a multi-month rally and that the miners are looking to be in a similar situation as they were before their big run in early 2016. January has already seen gold acting stronger when compared to other markets so far. Let's get your thoughts on this.
Sure. Well, as most people know, gold peaked back in 2011, and as did silver, and we've been through a long consolidation since then. I think I'm probably among the most bullish gold strategists out there at this point. I compare what I think we're going to see in the first half of this year to what we saw in the first half or early two-thirds of 2016. Quite similar, in fact, in terms of the moves. I'm looking for gold to move up to 1550 by mid-year, and silver maybe $26 by mid-year. So those are pretty big moves. They're coming out of several years of down, and I think a lot of people have abandoned gold and silver, have gotten very frustrated. Every time it lifted its head, it corrected again. So I'm looking for this. We've had good strength in it really for the last 3 months, and particularly in the last month or so. So I think we're in good stead. I've started what I think is going to be a very strong move. I think a good part of it is driven by a dollar that's going to roll over here. It started to roll over in 2016. The dollar went from in 4 months went from 100 down to 92. I expect this move to be similar in that I see it moving from the current levels near 96 down to 85, 86. And that should be a real propellant to the precious metals.
Very good. David, you talk about massive leverage in the global economic system as a whole that will eventually trigger a deflationary bust in perhaps the second half of 2019. Can you give us some details about this and why 2019 may be the year for this to occur? You do also suggest that there'll be a melt-up in the S&P 500 and the Dow Jones during the first half of this year that will be perhaps a precursor to this?
Yeah, let me start with the melt-up first, I kind of jokingly say, but I don't think it's really far from the truth, that I may have the most extreme bullish view on the market for this year, as well as the most extreme bearish view, both in the same year. I called it in my most recent letter a tale of two cities. I think we're going to have a very, very strong market in the first half and a very weak market later in the year. So the melt-up, I think, comes from the fact that we had such a violent fourth quarter, particularly culminated on Christmas Eve with the kind of indiscriminate selling that went on then. We had sentiment get down to levels that we hadn't seen in some cases, certainly hadn't seen for several years, but in some cases hadn't seen since the 2008-9 bottom. So you had extreme bearish sentiment build up because the tape got so negative, and people kind of jumped to the obvious conclusion. There are a lot of excesses in the market and in the global economy right now. So it's easy to start saying, is this the big rollover? Are we going to see a big bear market come out of this now? So with the tape getting so negative, people quickly jumped to the conclusion, okay, we're in the bear market now. Obviously, some of the indexes got into bear market territory, and you started seeing people play leapfrog in terms of trying to outdo the last person in terms of their downside targets. That's the kind of backdrop that usually creates a bottom. I think we did create an intermediate bottom back in December, and going along with that, when a rally started, people sat on their hands and said, we'll decide whether this is any kind of a meaningful rally after we retest. We always get a retest. Let's sit back and wait. So particularly hedge funds who had bailed out didn't redeploy. Many of them didn't redeploy their cash all the way up through this big rally we've had for the first 6 weeks of the year, and as a result, we're some 15, 17% off the bottom, and they're feeling pretty uncomfortable that we haven't seen a retest yet. So I think at some point, it's probably at some point up over 2,800 as we approach the old highs, they're going to capitulate and say, I got to get in here, and you will see some sort of a buying panic set in that will be multi-month and could take us. My target on the S&P for this year, my high target is 3,500 plus. And this will be what I call a parabolic final leg to the secular bull market that I believe started back in 1982. I use that. Many people have different secular bull market time frames. I use 1982 because that was the start of the whole disinflationary trend where P multiples expanded dramatically over 36 years, and so I think we are approaching a secular peak, and I say 3,500 plus because I don't know whether it's going to be 3,500, 3,700, 4,000. Once you get into that final blow off or that final melt up, it just goes straight up, and it's not really a number that matters. So I think that's what we're in for between now and mid-year. And then on the other side, because of the massive leverage in the global economy, I think we have immense risks out there, risks we haven't seen in the history of markets. I mean, this is one for the ages in terms of 250 trillion in global debt and over a quadrillion in notional value of derivatives. And by the way, we didn't even have derivatives to any real number back in the 80s, back in the mid 80s. So this whole derivative buildup has occurred since then. So we are dealing with things that we've really never dealt with on this magnitude, and it's once it starts unwinding, I think it's going to unwind very quickly and very fiercely. So I think that could happen at any time, but I think the likelihood is it's something that happens latter part of this year, second half of this year sometime. The trigger can be many things. One of those things, and what I like to do as a formula is, massive leverage combined with a big central bank policy mistake equals bust. So I am calling for a global bust. I coined the term global deflationary bust back several years ago when I started seeing this buildup, and people weren't even using the term bust then. You see the term bust now all the time. I was using it because I wanted to differentiate it from a depression. I don't think this will last very long. I kind of nickname it 2008 on steroids. I think it'll be similar to that in terms of how fast we unwind, just bigger than that. And it'll come with some sizable involuntary debt liquidation. It will come with some sizable bank failures. In 2008, it was U.S.-centric. I think this time it's probably more outside the U.S., but that doesn't mean our banks are immune from it. I think you might see a major bank over here or two go under. I certainly think the European banks are vulnerable, some of the Asian banks. So we're looking at something that's going to be pretty traumatic, but I think it happens in short order, and it could be, same time frame or less than what we saw in 2008-9. So that one really was, less than a year. This one could easily be less than a year, particularly in terms of the markets. Obviously, the the hangover effect of that carries on for many years into the next cycle. So it's not like you're, down and then everything's glorious. But I do think the real unwind will occur in a matter of months, and then there'll be a recovery cycle. The response to the bust is very predictable. It will be massive QE around the globe. I think it'll be QE many times what we saw this cycle. So those people that are worried about the $4 trillion that was pumped in, or close to $4 trillion pumped in this cycle by the Fed, it'll probably be 3-4 times that to deal with what I will be calling what I call a free-falling financial system. In 2008, we stopped it with TARP. This time there'll be no TARP, or at least not in a timely fashion. People are pretty turned off to that. So it's going to be the tool that can move quickly, that they can deploy quickly to deal with something that's going to, with an unwind that's going to happen quickly. The only tool available in that respect is QE. So we will see a lot of money printed, and they'll print, and then they'll look and see that because it's going to be a long lag time to when that actually has an impact on the economy, and they're just going to keep printing. They'll print, look, and say that nothing's happened, print some more. They'll just keep printing until they finally stabilize things. So I think it's going to take a lot, and I think that will be music to the ears of gold. Not immediately, though, because in the early stages of it, as I said, it's not just a global bust, it's a deflationary bust. The first global deflationary downturn in, since the Great Depression. So I think people misunderstand what deflation is or miscategorize it. Japan was kind of a benign deflationary cycle, and that's what I think people think deflation is. It's just a little bit below zero, and it's, you get a benefit of being able to buy goods cheaper. Deflation in the form that we had in the Great Depression and the form we're going to have here is, very destabilizing and quite frightening. Unemployment jumps pretty dramatically. Lots of corporations go under, et cetera. So, like I said, they'll stop it in a hurry. And there'll probably be lots of moratoriums on debt, et cetera. But in the meantime, it's not going to feel like anything but a depression. So that's what I think we have in store for 2019. It's going to present some opportunities for those that are anticipating some of this, but it's also going to be one hell of a ride, and not all of it fun.
You have a wealth of experience in the markets, David, spanning over 40 plus years on Wall Street. So give us an understanding of how you began your journey as a contrarian in the markets. And during your career, have there been any key turning points that you have capitalized on immensely? All contrarians tend to be very early in a market as they wait for their thesis to play out. And because of this, it's usually a test of patience and the ability to not do anything once they are positioned that marks them as a successful contrarian investor. Has this been your experience?
Definitely. I started in the business back in 1973. I came right out of college. I knew what I wanted to do. I was a finance major in college, so I ended up in a situation. It was a small bank where they had an investment department, and it was the fact that I came in at that time. Within a year, I saw what turned out to be the biggest bear market and biggest downturn that the U.S. had in the post-World War II era to that date. So, it was the crash of the Nifty 50 stocks, and so I learned early on in my career the importance of risk management, the importance of, and not that I was really managing money then, I was working with somebody on it, but it really hit you between the eyes how important it was to manage a portfolio for risk, and how things happen in a hurry, and from it really I think was the best thing that could have happened to me as an investment manager in terms of learning early on about risk, and that has basically characterized me and personified me from that point forward. Going through many cycles is, risk was always something I looked at. I think I was naturally so, but I certainly became a value manager as a result, or it reinforced that tendency anyway. So I spent the first half of my career, 45 years, in investment management. I went from managing personal money to managing institutional money, managed Textron's equity pension funds back in the 80s, and was top 1 percentile performance among pension managers in the SEI universe back then for 5 years running. I did that, I came into Textron in the end of 1981, basically early 82. We were in the midst of a bear market. I said, and I was brought in to run the equities. I was, barely 30 years old. And I said, sit on our hands. Let's watch this thing. This thing's still unwinding. And in August of 82, we hit the ground running and started deploying funds. And they went from having 50 million in equities out of a $500 million portfolio to, by the time I left 5 years later, having 500 million in equities out of a $1 billion portfolio. And it was with a group of the investment committee was all their senior officers in the company, and CIO, the CEO, the chairman, and treasurer, et cetera. And these guys were all in their 50s and early 60s, and they're looking at this 30-year-old kid telling them he could manage money conservatively and outperform. And they had been burnt in the 74 market, and their chairman at the time pulled all the money out of New York City banks and put it in, brought it home in-house, and they were primarily in fixed income and private placements until I came along. So it was kicking and screaming I brought them along, but because we had such good performance, the credibility built, and they understood that equities could be a good thing. So that was, and I did that recognizing in 1982 that we were seeing inflation peak in terms of a very important long cycle perspective, and that going forward, even though disinflation wasn't a term then, I was the concept I coined at that point and said, we're going to begin to see inflation ratcheted down over the next several cycles. Little did I know what we had in store. I saw some of it. I didn't see the move all the way down towards zero, but I understood that to mean you want to, inflation is yesterday's story, so you want to de-emphasize inflation stocks and emphasize disinflation, because disinflation stocks are flat on their back because everybody's worried about inflation. So I was able to accumulate what I at that time saw as the most attractive part of the market, growth stocks, which were Philip Morris, the drug companies, lots of things where you had steady growth, but people had devalued it because of inflation. And I was buying Coca-Cola at book value, Eli Lilly, Merck, those kind of things, and those things did very well through the decade of the 80s. Many of them multiplied 20-fold from their bottoms, and meanwhile everybody's loaded up in energy stocks and things that had done so well in the 70s and into the early 80s, and those things became the albatross around people's neck, because of inflation rolling over and prices coming down. So not having those in the portfolio, I didn't have that ball and chain dragging down performance, and then I was getting the benefit of the wind at the back of the growth stocks. So that was one big cycle move. I, in the early 90s, took a position that I saw as similar to that, where I could come into a company that had de-emphasized equities and became head of active equities at ITT Hartford Insurance, and was running their property casualty equity portfolio that had been all moved out of active equities and put in, they put some back in. They closed out a big shop back in the mid '80s because they did the opposite of what I was doing, and then put some back in a couple of years later into index funds. And I came in to run an active equity effort to rebuild it. And I said, kind of quite the opposite of what I did in the early '80s. I said, we've had this big run in consumer growth stocks. You're now at 60-year lows on capital goods versus these consumer stocks. It's time to reaccumulate capital goods stocks. So in my portfolio in the early '90s, I was loaded up. Half my portfolio was technology stocks, particularly semiconductor and semiconductor equipment stocks, flat on their back, and then other heavy equipment stocks, the Caterpillars of the world, the Deeres of the world. So those things were all out of favor, and we had a great run in the '90s, as you know, particularly in technology. So it was interesting, though, because I was a year early talking about that, being of a value persuasion, being contrarian. You're often early, and that's my tendency, and I was a year early. And in that year where I had no consumer stocks, I did the opposite of what I had at Textron, and I had all capital goods, or mostly. The consumer stocks had their final parabolic blow-off, as happens at the final stages of a cycle, a secular cycle. And I was sitting there with, Coke doubled and doubled again, or things like that. My portfolio lagged the S&P for that year. I think it was 1991, if I'm right, by 6%, so 600 basis points. And the guys that were still there running the index funds are, mocking my performance and saying, see, active management doesn't work. This guy's not really worth having here, et cetera. 600 basis points behind, he'll never catch up. Well, in the next 2 years ensuing, I think it was basically from mid-92 to mid-94, the S&P went up 2%, and my portfolio went up 50%. So I outperformed by 4,800 basis points. So that's the nature of being a contrarian investor, and also having the convictions to concentrate your portfolios. That's not, that's certainly not what's preached by the majority of people out there. Particularly on the advisor side, it's all about diversification, and it's all about, kind of having a lot of, not making bets in big sizes. So I tend to run money different than that, do quite differently from that, but you have to really know your stuff to be able to concentrate. 45 years does give you the benefit of, I've certainly made my mistakes, as anybody does in this business, and the difference between a good money manager and a bad one is you learn from those mistakes. And I'm somebody that observes cycles, and every cycle is different. So there's an awful lot of learning that goes on through 45 years of doing this, and I really, looking back on this, I say this to a lot of new people that come into this business. You can read about things. There's no substitute for living through cycles. You really see things quite different than the history book might point out. They miss the nuances. So that's kind of how my career has gone, and I'm probably more contrarian than ever before. But there are a lot of contrarians out there today, or self-professed contrarians. A lot of it, I think, is, there are different kinds of contrarians, I guess, but a lot of it is not. I'm not a knee-jerk contrarian where it's just, you say that, I'm going to go the other way. I think some of it is, I think good contrarians are born with the trait, but I think some of it is also, you got to know when to be contrary and when not, because there are periods of time in all cycles where the consensus is right.
Excellent. Well, thank you for sharing that, David. That was fascinating. Okay, as we wrap up the show, is there anything else you wish to discuss today?
Well, I would say, the final thing that I haven't talked about is the bond market, and I'm probably the most bullish, and I think almost definitely the most bullish bond strategist out there or strategist out there on bonds. I believe we're going to see the 10-year rate get down to 0.5% and the 30-year down to 1%. And I think if my targets are wrong, they're probably still not low enough. Because of the deflationary bust, I think by the end of this year we could see those targets reached. It will be the culmination of a 37-year bond bull market. It started back in 1981 when those rates were at 15%, and because of disinflation and then ultimately deflation, you take it all the way down to the extreme. That will mark what I think will be the top of the bond market, and then I think the next cycle, because of all the money that would be printed to deal with the bust, you will jumpstart an inflation cycle that we haven't seen since the 70s. We've had disinflation since the early 80s, so most people in this business have never seen an inflation cycle. I think that the 2020s will be all about inflation. So deflation will beget inflation, and so I would say you've got one more year to enjoy bond returns, and I think they're going to surprise most people in terms of how well the bond market does this year. And then I would tell you that at least I, as a money manager, would not own a long bond from that point forward. The T-bills will be the place to be if you have to be in fixed income starting in 2020, and because every time they roll over, they'll be rolling over at a higher rate. If you're locked into a bond, you're obviously watching your bond deteriorate as rates go up. So I think we're in for quite a decade ahead, and I would just caution people, there's an awful lot of what I call macro tourism out there. Everybody has become a macro analyst. Most of those people have just enough information to be dangerous. So just be careful not to get too caught up in narratives, because the popular narratives oftentimes sound very compelling but turn out to be quite wrong, or they just miss pieces of it that are very important. So that's, I guess, how I would end it.
Excellent. Well, thank you for your time today, David. Very much appreciated. And I'm sure we'll have you back on the show again later in the year.
Okay, appreciate it very much. You take care, Karen.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?